Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to adjust for non-controlling interest in the consolidated financial position. So how do we calculate, how do we ascertain the value of the non-controlling interest at the end of the year for the consolidated financial position? So let's look at this question. Again, we start with the requirement. And let's see the requirement. What amount will be presented as the non-controlling interest in the consolidated statement of financial position of Runico at 31st December X6? So let's see. Runico acquired 70%, so 30% would be NCI of the equity share capital of Marik. So Marik is a subsidiary. Is only subsidiary on 1st January X6. So you need to reconcile this to the year end. So to the year end, that is full year, which is 12 months. Very important to note. Now the fair value of the non-controlling interest in Marik at the acquisition date was 1.1 million. And I know that the pro forma for the non-controlling interest, so non-controlling interest in the consolidated statement of financial position, is that I need the NCI at acquisition date. So the NCI at acquisition were given to be 1.1. Then I'll add their share of post acquisition profit. So if it's a loss, I'll add their share. So let's build up with a question. Now, at that day, the fair value of Marico's net asset were equal to their carrying amount, except for a building which had a fair value of 1.5 above its carrying amount. So there is fair value depreciation that will arise, and it means that the NCI will share. So what I will do is to say share of fair value depreciation, and let's see, it is 1.5 and 30 years remaining. Remember, it's full year. So 1.5 million divided by 30, then times the NCI percentage. We don't time a portion because it's a full year. So 1.5 divided by 30 times 0.3, that should give me 0.015. And this is a deduction. Take note of that. And this is a million. Now let's build it again. During the year ended to December X6, Marik sold goods. So Marik is the subsidiary. Marik sold goods to Rooney, giving rise to unrealized profit in inventory of 550 at the year end. And because Marik sold the goods to Rooney, the NCI would have to share in the unrealized profit, because the unrealized profit is in the books of the subsidiary Marik. So I'll come here again and update the pro forma and say share of PURP, and the value was 550, and that should be 0 in million. That should be 0.55. So 0.55 times their percentage, which is 30%. So let's see, 0.55 times 0.3, that should give us 0.165, also a deduction. So we're still building on. Now, Marico's profit after tax for the year ended December X6 was 3.2. So their share of profit. So their share of profit is 3.2 times 30%. Remember, it is full year, so we don't time apportion the profit, and that should be 0.96. So let's see the adjusted figure. So we have 0.96 plus 1.1 minus 0.015 minus 0.165. That should give us 1.88 million. And 1.88 million is 1,880,000. And from the options, the answer should be D. So remember that in calculating the NCI for the consolidated financial position, you need the cost of the NCI at acquisition, or the value, their share of profit or loss. If there's any impairment, you have to share it. If there is fair value depreciation, you have to share it. And if there is unrealized profit, you have to share it. I hope this helps you in the preparation for your FR exam. Please subscribe to this channel to receive updates on new videos.